Wake up. You're being hunted. Every time you open your laptop, every time you check a 5-minute chart, you are entering a high-stakes arena designed by the world's most sophisticated minds to extract capital from the impulsive. You've been told the market is a fair auction. It's not. It's a liquidity-seeking missile. Think about the last time you felt certain. You saw a head and shoulders pattern or a perfect double bottom. You felt that rush of dopamine. You entered the trade, set a responsible stop loss, and within 10 minutes, you were wiped out, only to see the price move exactly where you thought it would go. That wasn't a mistake in your analysis. Your analysis was actually too correct. You found a level that everyone else found, and because everyone found it, everyone put their stops in the same place. To a Goldman Sachs or a BlackRock desk, that cluster of stop losses looks like a giant pile of cash sitting on the sidewalk. They need size. They need to fill orders for 10, 50, 100,000 lots. If they buy in a thin market, they drive the price against themselves. So they wait. They wait for you to build a support level. They wait for you to feel safe. And then they pull the rug. This is the liquidity trap. It's the bread and butter of institutional trading. If you want to survive 2026, you have to stop thinking like a chartist and start thinking like a liquidity provider. We are deconstructing the deception piece by piece. No fluff, no filler. Just the mechanics of the heist. Let's talk about order flow architecture. Markets move from areas of high liquidity to areas of low liquidity. Liquidity is simply orders. There are two types, visible and hidden. Visible liquidity is the order book, the level 2. You see the walls. But the smart money knows the real prize is the hidden liquidity. These are the stop market orders sitting in the dark, just outside of price ranges. Imagine a consolidation range. Price is bouncing between $50 and $52. For 3 days, it stays there. The retail crowd is getting comfortable. They're buying the $50 dip and selling the $52 rip. Beneath $50, there is a stop-loss graveyard. Above $52, there is a buy-stop heaven for the shorts. The institution wants to go long, but they don't want to buy at $51. They want $49.50. Step 1. The lull. They let the market go quiet. They stop providing support. They let the natural sellers push the price down. Step 2. The catalyst. As price approaches $50, they hit the sledgehammer, a massive sell market order designed to break the floor. The moment $50 breaks, the stop-loss graveyard wakes up. Your stop-loss is a sell market order. Thousands of them trigger at once. Step 3. The absorption. This is the moment of the trap. As the retail crowd is panicking and selling at market, the institution has a passive buy limit order sitting at $49.50. They catch the falling knife. They absorb every single share you're selling. Step 4. The V reversal. Once the selling pressure is gone, because all the retail stops have been hit, there are no sellers left. The institution then places a small market buy order, and because the sell side of the book is empty, the price rockets back above $50. If you see a support level break and then a reclaim within 3 to 5 candles, that is a 90% probability signal that the smart money has entered. You don't buy the support, you buy the reclaim of the support. You can fake a price move. You cannot fake volume. Volume is the truth serum of the tape. In a 30-minute window, we have to look for volume anomalies, specifically effort versus result. Think of price like a car and volume like the gasoline. If you floor the gas pedal, high volume, you expect the car to travel a long distance, big price move. If you see a massive spike in volume, twice the daily average, but the price candle is a doji or a hammer with a tiny body, you have a massive divergence. The gas was used, but the car didn't move. Why? Because of hidden resistance or hidden support. When a whale wants to stop a move, they don't use a market order that shows up on the chart. They use passive liquidity. They let the trend run into a brick wall of limit orders. If the market is crashing, and you see a candle with a huge bottom wick and the highest volume of the day, that is the climax. That is the institution saying, no further. They are absorbing the final panic. The divergence play. Watch for lower lows in price, but higher lows in the volume profile. This is the bullish divergence of the smart money. It means that as the price is getting cheaper, the aggressive selling is actually decreasing, and the passive buying is increasing. Retail sees the lower low and shorts the breakdown. Smart money sees the volume exhaustion and prepares for the squeeze. In 2026, the squeeze is the only trade that matters. It's not just about where they trap you, it's about when. Institutions know your psychology. They know you're impatient. They know you have opportunity cost anxiety. This is why they use the time-based shakeout. Have you ever held a stock for 3 weeks, watched it do absolutely nothing while the rest of the market went up, and finally sold out of pure boredom? And then, the very next day, it went up 30%? That wasn't a coincidence. That was time decay of the retail mind. Institutions will park a stock. They will create a high-frequency chop. They use algorithms to buy 100 shares, sell 100 shares, buy 100 shares, keeping the price in a 10-cent range for days. They are waiting for the supply to dry up. They are looking for the last seller. They keep the price boring until the open interest drops. When the retail traders have all left to chase the hot stock of the day, the institution is left holding all the shares. With no one left to sell, the path of least resistance is up. To beat the time trap, you have to change your time horizon. If you see a stock with massive institutional accumulation, high volume at bottoms, that is doing nothing, don't sell. That is the quiet before the storm. The longer the base, the higher the space. We are moving into a market dominated by AI and predatory algorithms. The old ways of drawing a trend line and hoping for the best are dead. If you want to win, you have to be comfortable being wrong, according to the textbook. You have to be willing to buy when it looks like a breakdown. You have to be willing to sell when it looks like a moon mission. Your 2026 checklist. Identify the consensus level. Where is the most obvious support? That is where the trap will be laid. Wait for the stop run. Do not enter on the first touch. Let the weak cans get cleared out. Confirm with the reclaim. Wait for price to snap back into the range. Verify with volume. Did the stop run happen on high volume? If yes, the smart money has filled their bags. The market is a mirror. If you look at a chart and feel panic, ask yourself, who is profiting from my fear? If you feel euphoria, ask, who is profiting from my greed? Stop being the liquidity. Start being the predator. The trap is set, but this time, you're the one holding the key.